Good afternoon, everybody. Scott Riley with the Market Update Desk, October 23rd, NMLS number 157524. Well, we got a lot more red in the market today. It has been an absolute bloodletting in the 10-year bond and mortgage-backed securities for the last 2-3 weeks. We want to talk about a little of what's going on, a little more depth of what's going on with that, maybe where some resistance levels are that'll give us some relief and maybe start to turn the tide a little bit, hopefully. Today we did have a 20-year bond auction that it didn't go all that great. It got rated a C. There's still a lot of uncertainty with the amount of inventory that's going to be available with increased government spending and more issuance of treasuries. So that bond sale did not help us today at all. Also, we did get the Fed beige book today. So that was, there wasn't anything super surprising in that. And, the market's kind of not focusing on that as much. Now, one of the main reasons that the bond market has struggled all October, now historically, actually, if you look back at multiple Octobers, there is a precedent and seasonality to this when you go back and look at the data. And it's indicating that the U.S. debt is exploding higher and increased by 600 billion in just the last 2 months. We're quickly approaching 36 trillion in debt to GDP ratio is now 124% for 2024, which is an extremely high ratio. One of the legendary investors, Paul Tudor Jones, are saying that they're shorting the bonds because there's too much debt. We're actually seeing a very large short growing in the bond market, and that's pressuring these bonds. So we've got multiple facets that's going on, and the Fed speakers that are out there talking about we're nervous about more rate cuts and the pace of rate cuts. So the Fed commentary, the explosion or re-explosion, as the case could be, of debt, and the concern about the amount of inventory of treasuries that are hitting the market, depreciating the value, and the shorting of the market is really causing this firestorm within the bond market. Now, for buyers, it means rates are definitely higher, but it means there's a few less buyers out there because they're nervous. Now, being that we're starting to get into the fall-winter market, we've talked about it, having a little bit higher interest rate is going to cost you less than having a higher sales price competing against multiple offers with multiple bid over ask sales prices. So even though you pay more a little bit in interest rate, you're going to save more in total acquisition cost. Existing home sales came out today, and that measures closings on existing home sales in September, which means they're probably shopping July, August. Showed an annual pace of 3.84 million units, which was in line with estimates. Now, sales are still down 3.5% year over year. And again, that has to do with a few different things: interest rate, politics, concern on economy. Now, the inventory did increase about 1.5% month over month to about 1.39 million units. Now, inventory is up about 23% year over year. Excuse me, but it's still down 24% from pre-pandemic levels. We're showing nationally there's about 4.3 months supply of homes, still short of what a balanced market is of 4.6. Locally here in West Michigan, we have gone up, but we're probably still sitting at about, 1.5 months inventory, which is still extremely constricted. Homes remained on the market 28 days, which has crept up about a day. Crept up from 26 days on the market in August. We also saw 20% of the homes sell above list price, showing there is still bidding for the right home that's priced at the right amount. Median home price came in at $404,500, which is up 3% year over year. Locally, I'd say we're definitely above that appreciation level. First-time home buyers accounted for 26% of sales. Cash buyers ticked up a little bit to 30% from 26%, and investors made up 16% of the total population of buyers. Now, purchase applications for the mortgage apps for the week are down 5%. And year over year, they're up 3%. Refinances fell, unsurprisingly, about 8%, but we're still way up year over year. As rates potentially settle in this area, we're probably going to see flat on purchase applications and negative on refinance applications. Technical side of things, the 10-year bond this morning blew past the 200-day moving average, unfortunately, and that's got us at about 4.33. I'm sorry, 4.26. The next level of resistance is at 4.33. And then from there, we go to about 4.44. And then the third layer of resistance overhead is about 4.51. The good thing is we do have about 3 very solid lines of resistance above us, but there's not much right now, at least, that's stopping it from moving upward. So I think we're going to continue to see this upward trend on 10-year bond and mortgage rates. The mortgage-backed securities are down dramatically. Mortgage rates have gone up over 1% in the last 6 weeks. That means if you didn't strike on your purchase or refinance, when a lot of us were telling buyers and homeowners to take advantage of it back 6 weeks ago at, in the high fives, middle to high fives, we're now sitting at almost 7%. Take advantage while the rates are there, because if you wait, like a lot of people did, thinking that the media is right, talking about lowering rates when they really don't understand the correlation of Fed funds policy to mortgage-backed securities and 10-year bond, it's going to cost you money. We will eventually get to lower rates, but I think it's going to be pushed farther down the road than first anticipated. The concern now in the market is, will we get a rate cut November 5th, I believe is what it is, and will we get one in December? If so, what are the sizes? And then what's the forecast for next year with the terminal rate? These are all very volatile expectations right now. Now, next week, we do get some critical data with inflation reports, and then the end of the month, we do get jobs report. We'll stay on top of everything. Give us a call, help you get into a house, 616-293-2189. Have a great afternoon.